Hi everyone, I am Dr. Soundararaj. I am very happy to interact with you all through this video. In this video, I am going to give a lecture on the topic Accounting Rate of Return Method, which is shortly known as ARR. In this video, first I will take you through the theoretical background of ARR, followed by I will explain the accounting treatment of ARR using a problem. These are all a couple of details related to my career. After you watch the full video, if you find the video useful to you, give a like to the video and do subscribe my channel so that you will get the notifications of my future videos. Let's get into the details of rate of return method, which is otherwise known as accounting rate of return method or return on investment method or average rate of return method. According to this method, various projects are ranked in order of the rate of earnings or rate or return. Projects which yield the highest earnings are selected and others are ruled out. The return on investment can be expressed in several ways. We will be discussing about the ways they have suggested. There are about 4 ways. We'll discuss them one after other. So using ARR method, a business enterprise could rank the alternative projects according to the rate of return the project is going to generate, the accounting rate of return it is going to generate if the project is implemented, and that is what the idea. Accounting rate of return method is also one of the traditional methods of capital budgeting because it doesn't consider the time value of money. It considers only the accounting profit for calculation of rate of return, followed by the projects will be ranked one after other based on the rate of return. The first one is about average rate of return method. Here average profit after tax and depreciation. Obviously if profit is after tax, it is after depreciation also, is calculated and then it is divided by the total capital outlay or total investment in the project. This method establishes the ratio between the annual average profits to total outlay. So first we sum up the total profits from the project for the entire lifetime of the project and find the total of them. The total profit will be divided by the lifetime of the project so that we will get annual average profit of the project. Annual average profit or average annual profit divided by outlay of the project into 100, it will give us average rate of return. This is a popular method. Project giving a higher rate of return will be preferred over those giving lower rate of return. The second one is about return per unit of investment method. In this method, the total profit after tax and depreciation is divided by the total investment. This gives the average rate of return per unit of amount invested in the project. The formula for this particular calculation is total profit divided by net investment into 100. So it will come in terms of percentage. Then the next one is about return on average investment method. Under this method, the percentage return on average amount of investment is calculated. To calculate the average investment, the capital outlay of the project is divided by 2. Now let's look at the formula for calculating return on average investment. Total profit after depreciation and taxes divided by total net investment divided by 2. This is what about the idea behind the third method suggested here. Then the fourth one is about average return on average investment method. Under this method, average profit after depreciation. See, average profit. That means average annual profit after depreciation and taxes is divided by the average amount of investment. This is an appropriate method of rate of return on investment. What is the formula for calculating average return on average investment? Average annual profit divided by investment divided by 2 into 100. See, among the 4 methods, the first method average rate of return method and the fourth method average return on average investment method are widely used, whereas the second and third methods are only in theory form. I don't find any concerns widely use the second and third methods for evaluating their investment proposals. Now let's look into the problem given and how they calculate the average return on original investment and average return on average investment. That means the first method and the fourth method. Calculate the average rate of return for projects A and B from the following. Investment for project A 20,000, for project B 30,000. Expected life no salvage value. That means at the end of its lifetime, project A and project B will give nothing if the projects are disposed. So lifetime of project A 4 years, project B 5 years. Projected net income after interest, depreciation and tax, which could be simply named as profit after tax. Profit after tax certainly is after interest and after depreciation as well. So you can simply say EAT or PAT, earning after tax or profit after tax. That's very simple. Project A, the projected profit for the 4 years of project A presented here 2,000, 1,500, 1,500, 1,000, the total comes to 6,000. Whereas for project B, the projected income for all the 5 years are presented here 3,000, 3,000, 2,000, 1,000, 1,000, the total comes to 10,000. If the required rate of return is 12%, which project should be undertaken? That means this concern suggests that a project could be accepted if the rate of return of the project is certainly above 12%. If you have two choices or more than two choices of projects, the project which gives a higher rate of return certainly over and above 12% will be chosen, and the rest of the projects will be ignored if they are mutually exclusive projects. Fine. Now project A and project B, which are mutually exclusive projects, so we have to decide which one of the two is to be chosen profitably, making use of the method accounting rate of return based on original investment and based on average investment. Now total profit after interest, depreciation and taxes for project A 6,000, project B 10,000 given in the problem. Lifetime 4 years for A, 5 years for B. Average profit. Now total profit 6,000 divided by 4 years, it will give you the annual average profit of project A as 1,500. And similarly for project B, total profit 10,000 divided by lifetime 5 years, it gives us 2,000 rupees as annual average profit of project B. Investment of project A 20,000, project B 30,000. Now let's calculate the average return, rate of return on original investment as per the first method suggested in the theory. 1,500 is the annual average profit divided by original investment 20,000 into 100, it gives us 7.5% as average rate of return on original investment. This is for project A. For project B, annual average profit or return comes to 2,000 rupees divided by original investment 30,000 rupees into 100, it gives us 6.6%. What about average return on average investment? 1,500, this is the annual average profit. The numerator will be common for both method 1 and method 4. Therefore, the same 1,500 annual average profit is a numerator here also. But the denominator here is average investment. How to calculate average investment? Original investment divided by 2. Original investment is 20,000. So 20,000 divided by 2 into 100, it gives 15%. Then for project B, 2,000 rupees annual average profit divided by average investment, which is nothing but original investment divided by 2. 30,000 divided by 2 into 100, it gives us 13.33%. That's an average rate of return on average investment for project B. Now looking at these details, we can easily say project A is more profitable than project B because the average return on average investment and average rate of return on original investment of project A are much higher than that of project B. Therefore, project A is recommended. Now merits of accounting rate of return method. Number one, it is simple to understand and easy to calculate. The reason the input for calculating accounting rate of return could be easily gathered from the financial accounting records because it makes use of only the financial profit which is calculated based on accrual accounting method. That is why it is very easy to understand and easy to calculate as well. The second one, it takes into consideration the total earnings from the project during its lifetime. Thus, this method gives a better view of profitability as compared to payback period. So comparing payback period, this method is a better method because it considers the total earning of the project for its lifetime. Then the third one is about, it is based upon accounting concept of profit. It can be calculated from the financial data, and that's what I said. The input for calculating ARR could be derived easily from the financial records of a business, and that's a greater advantage this method enjoys. Regarding demerits of rate of return method, it ignores time value of money. Like traditional payback period method, accounting rate of return method also ignores time value of money. Therefore, profits earned in different periods are valued equally. This is really not fair in this present financial scenario. And the second one is about, this method may not reveal true and fair view in the case of long-term investments. Yeah, long-term investments which will have longer span of lifetime, and definitely making use of this method, we cannot accurately get the fair view of long-term investments. Our predictions could also go wrong with regard to the estimation of accounting profit from the project in its lifetime, which would be definitely more than 1 year. And the third demerit is what? It does not take into consideration cash inflows, which is more important than accounting profit. There are many concerns. Many concerns become bankrupt in spite of huge amount of profit they generate year after year. What is the reason? They are very poor in cash management. They sell the goods on credit but fail to collect the money from debtors. This eventually pushes the organization towards cash insolvency and bankruptcy as well. And that is why now companies are giving more importance for the data available in the cash flow statement. And it's a basic reason why now preparation and publication of cash flow statement is also made mandatory, and it has become part of financial statements of business enterprises. And the fourth one, it ignores the fact that profit can be reinvested. Yes, definitely profit earned in the first year could be immediately reinvested, but this aspect is not really taken into account in the calculation of ARR. Fifth one is about, there are different methods for calculating the accounting rate of return method. Each method gives different results. Obviously, it leads to greater confusion, and it reduces the reliability of accounting rate of return method from the viewpoint of business enterprises. I hope I have done my lecture up to your level of satisfaction on the topic accounting rate of return method. I will meet you in another video. Bye for now, everyone.